Okay, so let's unpack this. We're diving deep today into something really fundamental if you want to understand business investing, even just power dynamics inside companies.
Yeah, we're talking about stock ownership structures.
Exactly. And, well, the surprising punch that specific percentages can pack.
It's a core concept, definitely. Often kind of hidden behind jargon, but it's built on very specific numbers, specific mechanisms that once you get them, they reveal a lot about how companies are really controlled.
Right. And this deep dive, just so you know, is pulling its insights straight from one source, a book called One Book to Understand Stock Ownership Structures by Lee Liwei.
And our mission today is really to cut through that complexity, pull out the most important nuggets for you. We want to shine a light on those key percentages, the ones that act as triggers for different rights.
And also explore, fascinatingly, the different ways founders, owners can kind of maintain control even when they share equity, which is crucial.
Because at its heart, stock ownership isn't just one thing, is it? It's a blend. It's wealth, the money side, potential return, and it's power, the right side, the ability to influence or control what happens.
And the source points out these two things, they can actually be separated.
Right. It talks about different shareholder types. You've got the rare A type, wants both money and control, like a Bill Gates maybe.
Once at all.
Yeah. But more often, you see the B type prioritizing control above everything else, think Richard Liu of JD.com. And then the C type, like employees or financial investors, whose main focus is, well, the financial return, the money.
And that tension, right, between the B types, the founders needing control and needing to share equity with C types, the money people or key talent, without losing that control, that drives a lot of the structures we're going to talk about.
Precisely. And understand all this really starts with those specific numbers, those thresholds.
So let's jump right in. Let's decode those key stockholding percentages. Because the specific number you hold, it really unlocks different doors depending on the company type. We'll look across limited liability companies, non-public shareholding companies, new third board, and listed companies.
Okay, starting with limited liability companies, LLCs. There are a few critical numbers. The first one, 34%.
34. The source calls it the shareholder troublemaking line.
Yeah, troublemaking line.
Sounds like it lets you cause problems.
Well, it does, but specifically by giving you defensive power. See, company law often says certain major decisions need a 2/3 majority vote. That's 67%.
Okay.
So if you hold 34% or more, you alone can block that 67% from ever being reached.
Ah, okay. So 34 isn't about making things happen. It's about having a veto, blocking the big stuff.
Exactly. The source lists 7 specific actions here: changing the articles of association, increasing or decreasing registered capital, company merger, company split, dissolution, changing the company form, those kinds of fundamental things.
And the example in the book is super clear. 3 brothers, Bear 3 has 34%, Bull 4 and Horse 5 each have 33%.
Right.
If Bull and Horse want to change the chairman, they need to amend the articles, need 67%.
Yep.
Bear 3 just says no, blocks it, done.
It really shows how powerful a minority stake can be in preventing fundamental changes. It's a blocker.
Okay, so 34% is the blocking stake. What about 51%? We often just think of that as control.
And it is the absolute control line in the source, but, absolute here is relative to, relative control. Holding 51% does mean you legally count as a controlling shareholder.
Right.
You have significant power over most day-to-day decisions, but it doesn't mean you could do absolutely anything you want.
Because those same 7 major actions we just talked about, they still need that higher 67% threshold.
Correct. Unless the company's specific articles explicitly say otherwise, which is possible but not standard. So 51% is your general command, but 67% is needed for those really big structural changes.
Which brings us neatly to 67% itself, the perfect control line.
Yeah, this is the threshold in an LLC that gives you the most complete control, really. If you hold 67%, you can unilaterally push through those 7 major decisions. Again, assuming no weird clauses in the articles.
Got it. 34% blocks, 51% general control, 67% unilateral major changes.
Yeah.
Okay. The book also flags 20% and 10% for LLCs. What about those?
Yes, 20% is the significant influence line. This one's mainly relevant for accounting rules. If an investor holds between 20% and 50%, accounting standards generally say they have significant influence.
Okay, significant influence. And that means?
It means they have to use the equity method to report that investment on their own books.
How does using the equity method actually change things, like financially?
Well, the example the source uses is Huai Creation Star's investment in Yiming Shangpin. When YE held just under 20%, like 19.6%, they used the simple cost method. Their investment value basically sat there unless they got a dividend or sold shares. But crossing that 20% threshold meant switching to the equity method. Now, Yiming Shangpin's annual profit or loss directly impacts YE Creation Star's reported results each year. It kind of flows through onto their income statement.
Huh. So that percentage directly changes how the investment shows up on the books. Interesting. And finally, for LLCs, 10%, the request dissolution line.
Right. This tackles a really serious problem. Shareholder deadlock.
Right, when owners just can't agree and the company grinds to a halt.
Exactly. If shareholders who hold 10% or more of the voting rights, either one person or a group combined, find themselves in that kind of paralyzed situation, they can actually petition a court to dissolve the company. It's a legal way out.
A last resort, basically, when things are totally broken.
The source uses that example of the sewage treatment company. You have a 51% owner, a 41% owner, and an 8% owner. If the 51% and 41% guys are deadlocked,
The poor 8% shareholders just stuck.
totally stuck, they don't have the 10% needed to ask the court for dissolution or even enough to force a shareholder meeting under some rules.
So the takeaway is 10% can be a really important baseline for basic rights if you're an operational investor in an LLC.
It gives you some leverage, yeah.
Okay, moving on. Non-public shareholding companies. These are a bit more structured around capital. Do the percentages shift?
You do, yeah. Here, even 1% becomes notable. It's the shareholder representative litigation line.
Okay, what does that mean? Representative litigation.
It means if you've held 1% or more for 180 consecutive days, you gain the right to file a lawsuit on behalf of the company itself.
Why would a shareholder sue for the company?
Well, imagine if the directors or senior management do something that harms the company, maybe divert assets or something, and the company itself, maybe because the board is conflicted, fails or refuses to sue them. Qualified shareholders holding that 1% can step in and basically force the issue through the courts. It's a check on management power designed to benefit the company as a whole. Beijing Hongxi case is mentioned as an example that really pushed this concept forward legally in China.
So 1% provides this crucial check against potential misconduct. Very interesting. What else for these non-public companies?
3%. That's the shareholder proposal qualification line. This is the minimum stake you need to formally submit temporary proposals in writing to the board, usually 10 days before a shareholder meeting.
So your ticket to actually getting items onto the official agenda for discussion.
Exactly. And then 10% pops up again. This time, it's the convene shareholder meeting line. If you hold 10% or more, you can request an extraordinary shareholder meeting be called.
Useful if there are urgent things that need addressing outside the normal annual meeting cycle?
Definitely. And the 10% request company dissolution line also applies here. Same as in LLCs for that deadlock situation.
Right, same rule. Okay, now new third board companies. These are listed, but generally less liquid than the big exchanges. What percentages matter here?
Okay, so 67% makes a comeback. It's the major restructuring approval line.
67% again, high bar.
Yeah, it's required for shareholder approval of major asset restructurings, which are usually defined by hitting certain asset size criteria.
Why such a high vote needed for restructuring specifically?
It's seen as a shareholder protection measure. Restructuring is a fundamental change to the business, so it needs significant consensus, not just a simple majority.
Makes sense. Protects the smaller guys. What about just general control on this board?
Here, 30% is generally considered the actual control identification line. Holding over 30% of the voting rights is typically seen as enough to have control.
So lower than the 51% or 67% we saw in LLCs?
Yes, reflecting the different market environment, maybe more dispersed ownership. Then, at 10%, you hit the equity change reporting line. Investors reaching 10% have to report and disclose that within 2 days, and they actually face some trading restrictions during that short disclosure period.
Okay, 10% triggers reporting, and 5% is flagged as the important shareholder judgment line.
Yeah, 5% is a really busy threshold on the new third board. It triggers quite a few different obligations.
Like what, for instance?
Okay, so you need to disclose if you plan to reduce your shares below 5%. You have to disclose if 5% or more of your shares get pledged as collateral or frozen by a court. Also, once you're above 10%, you have to report every time your ownership changes by another 5% up or down.
Wow, lots of reporting.
Yeah, and it's also the minimum stake needed if you want to launch a voluntary tender offer to buy more shares. That's 5%. And it's the threshold where foreign investment over 5% needs to be filed for record keeping.
So 5% really puts you on the map regulatory-wise on the new third board.
It certainly does. Lots of paperwork involved.
Okay, let's tackle the most complex landscape. Listed companies, specifically A shares in China. Lots of percentages here, many tied to regulatory mandates because they're public.
Yes, exactly. So 67%, again, is the major matter approval line. For listed companies, this specific threshold is often required for resolutions on things like equity incentive plans and also major asset transactions, or providing guarantees if they exceed 30% of the company's total assets.
So big decisions need that two-thirds vote. The source made an interesting theoretical math point about needing almost 90% pre-IPO to keep 67% after the IPO.
Yeah, that's purely mathematical, because IPO rules generally require a minimum public float shares held by the public of 25%, or 10% for very large companies.
Right.
So if you do the math, to still hold 67% of the total shares after floating 25%, you'd need to have owned about 89.33% beforehand.
Okay.
But, and this is key, the source notes that in practice, you often don't need to actually hold 67% to control the outcome of a 67% vote. Why? Because public ownership is often very dispersed, and many small shareholders simply don't vote.
Ah, the apathy factor. So you can win the vote with less than 67% actual ownership.
Often, yes, which is partly why the actual control identification threshold for listed companies is generally lower. It's 30%.
Right. 30% is that key actual control identification line for A shares. Due to market liquidity and dispersed ownership, controlling over 30% is usually deemed sufficient for practical control.
And crucially, if you hit 30% and then want to buy more shares, that triggers the tender offer trigger line.
Okay, explain that. Tender offer trigger.
Right. Reaching 30% generally obliges you to make a mandatory tender offer to all other shareholders if you try to increase your stake any further.
What's a tender offer again?
It's a formal public offer to buy shares from existing shareholders, usually at a set price, often a premium, for a limited time. The mandatory tender offer rule at 30% is a regulatory protection for the other shareholders. It gives them a chance to sell their shares at a potentially fair price when one entity is consolidating control over the company. It's an exit opportunity.
Got it. Okay, what about the IPO itself? 25% was mentioned.
Yes, 25% is the standard initial public offering public float line. That's the general minimum percentage of the company's total shares that must be sold to and held by the public after the IPO.
Unless it's a huge company.
Right. The exception is for very large companies, defined as having over 400 million RMB in share capital. For them, the minimum public float is lower, only 10%.
Okay. What about percentages related to ongoing reporting? Or specific boards like the SciTech Innovation Board, the Star Market?
Sure. 20% comes up again. It's an equity change reporting line. If an investor reaches 20% ownership but stays below that 30% tender offer trigger, they need to file a more detailed equity change report.
More detailed than at 5 or 10%.
Yes, typically more comprehensive. Also, on the Star Market specifically, 20% is the SciTech Innovation Board incentive upper limit. That's the maximum cumulative shares that can be issued under all equity incentive plans combined.
And that's higher than other boards.
It is. Generally, other boards like the Main Board, SME Board, or Chinext have a 10% cumulative limit for incentives.
And the Star Market has more flexible rules for who can get those incentives, too.
Yes, the source points that out. Star Market rules are generally seen as more flexible. They might allow pricing incentives below market value in certain cases, and importantly, they can allow 5% plus shareholders or even the actual controller to receive incentive shares, provided they are also directors, senior managers, or key technical personnel.
Whereas other boards usually exclude those major shareholders.
Typically, yes. Non-star boards often explicitly exclude 5% plus shareholders, actual controllers, and their close relatives from receiving equity incentives.
Interesting difference. Okay, 10% seems to have a whole bunch of different meanings for listed companies.
It really does. It's quite versatile. As we just mentioned, it's the general max cumulative shares for incentives, except for the Star Market, which is 20%.
Right.
It's also the maximum percentage of its own shares a company can hold from share buybacks conducted for specific purposes, like employee incentives or convertible bonds.
Okay.
It's a threshold used for identifying associated parties or related parties when looking at significant subsidiaries of the listed company. It's that lower 10% public float requirement for those very large IPOs we talked about.
Got it.
On the Star Market, it's the minimum holding required for shareholders who hold special voting rights shares. And it's also a threshold used in assessing potential delisting conditions on Star, related to the percentage of non-publicly traded shares.
Wow. Okay. Incentives, buybacks, related parties, IPO structure, special voting, delisting risk. 10% touches a lot of areas. But 5% is called out specifically as a very important threshold, the important shareholder line.
Absolutely. This one triggers numerous obligations and really defines key relationships in the listed company context. It's arguably one of the most significant thresholds.
So what makes 5% so critical? Lay it out for us.
Okay, first, it's the threshold for identifying related parties for the listed company itself. Cross 5%, and you're likely considered related. Crucially, it also defines who is an insider for the purposes of insider trading regulations.
Now, insider trading carries huge penalties.
Massive penalties. So hitting 5% puts you squarely in that regulated zone. It also defines you as a major shareholder under rules related to share reduction disclosures. If you're over 5% and want to sell shares, specific rules and disclosure requirements kick in.
So crossing 5% basically makes you an insider and a major shareholder with all the compliance headaches that come with that?
Pretty much, yeah.
Yeah.
Then there's the equity incentive angle again. For most boards, being a 5% plus shareholder is an exclusion criteria. Yeah, you generally can't get incentive shares.
But on the star market?
It's potentially an inclusion criterion, as we discussed, if you also hold a key position. Big difference.
Definitely. What else does 5% trigger?
Also on STAR, if you're a contractual fund, trust plan, or asset management fund holding over 5%, you might need to disclose who actually controls the voting rights behind that fund. And hitting 5% ownership triggers the raising the plate threshold.
Raising the plate? Is that the official term?
It's the term used in the source, kind of a market slang perhaps.
Yeah.
But it signifies reaching that 5% level, which requires formal reporting and a public announcement within 3 days. Everyone knows you've arrived.
Public declaration at 5%.
Yes. And holding over 5% makes you subject to short swing trading rules. It means if you buy shares and then sell them, or vice versa, within a 6-month period, any profit you make from that short-term trade generally has to be disgorged, paid back to the company.
Discourages short-term speculation by major holders.
Exactly. 5% is also a foreign investment record filing threshold, similar to the new third board. On STAR, 5% plus shareholders also have specific disclosure requirements if they pledge their shares. And finally, a bit technical, but in shareholder votes specifically about equity incentive plans, the votes of shareholders holding 5% or more aren't disclosed separately in the way that votes from smaller shareholders sometimes are.
Wow. Okay, 5% is truly a watershed moment. You become a significant player with major reporting duties, trading restrictions, and insider responsibilities. Are there any key thresholds below 5% for listed companies?
Yes, a couple.
Yeah.
2%. This is the share reduction restriction line.
Restriction on selling.
Yeah. If a major shareholder, often defined as 5% plus, or certain other specific shareholders want to reduce their stake by selling shares through block trades on the exchange, they're generally limited to selling no more than 2% of the company's total shares within any 90-day period.
So it slows down large exits.
Exactly. And the source notes there are even stricter rules for certain pre-IPO shares, especially for previously unprofitable companies listed on the STAR market. They might face a lockup for 1-3 years and then only be allowed to sell a max of 2% per year in years 4 and 5. Very tight restrictions.
Okay. And the lowest percentage mentioned in the source for listed companies, 1%.
Right. 1% still carries weight. It's the independent director nomination line. Shareholders holding 1% or more, either individually or combined, have the right to nominate candidates for the board's independent director positions.
Gives even relatively small holders a voice in board composition.
Potentially, yes. It's also the single object equity incentive upper limit. This means that generally no single individual employee or manager can be granted incentive shares totaling more than 1% of the company's outstanding shares across all active incentive plans unless there's a special shareholder approval.
So it caps individual rewards from incentive plans. Okay. Even 1% grants a specific important right or sets a key limit. Phew, that's a lot of numbers.
It really is.
Each one unlocking different powers, obligations, reporting requirements, all depending on the context of the company type and the specific regulation.
It definitely shows how the regulatory environment uses these precise thresholds to try and govern behavior and manage relationships, especially in the public markets.
But, as we touched on right at the start, these percentages are really only one side of the coin. The other side is how you actually achieve and maintain control, particularly how founders can share equity, bring in partners, reward employees without losing the ability to steer the ship.
Right. And the source really emphasizes this. Sharing equity doesn't automatically mean sharing power. Remember, equity has those two components: the financial right, the money, and the voting right, the power. And those two can often be deliberately separated.
Which is how you get situations like Jack Ma controlling Alibaba with, what was it, less than 8% equity ownership around the time of its IPO?
Exactly. He had the voting power separated from the pure economic ownership.
Yeah. So how is this separation actually done? The source lays out a kind of toolkit with several methods. It lists, let's see, limited partnership, pyramid structure, concerted action, voting proxy, using the Articles of Association strategically, and AB shares.
Those are the main ones discussed, yeah. Let's maybe walk through how these tools work, starting with one that's become really common, especially for holding structures, the limited partnership, or LP.
Right, we hear about LPs a lot in the investment fund world. How are they used for corporate control specifically?
Okay, so an LP structure, fundamentally, has at least one GP, the general partner, and at least one LP, the limited partner.
GP and LP.
The GP typically manages the partnership's business and usually has unlimited liability for its debts. The LPs, on the other hand, are usually passive investors. Their liability is limited just to the amount they invested, and they typically don't participate in management.
Okay, so how does that translate to controlling a company?
Well, a common structure for control is having the key controlling individuals, the founders perhaps, act as the GP of a limited partnership. This LP entity then holds the shares in the main operating company. The employees or financial investors would be the limited partners in that LP.
Ah, so the GP of the holding LP effectively controls the votes of the underlying company shares, and the LPs in the holding vehicle just get the financial returns from those shares.
That's the beauty of an LP. Its flexibility. The partnership agreement, which is the governing document for the LP, is highly customizable, much more so than standard company articles.
Right.
So the agreement can explicitly allocate most or all of the voting rights associated with the underlying company shares to the GP, while allocating most of the economic profit distributions to the LPs. It perfectly allows for aligning the different desires. Founders get control, power. Investors' employees get financial upside, money.
The Hikvision case study in the book seems like a perfect illustration of this in practice.
It's a classic example, yeah. Hikvision wanted to give equity incentives to a lot of employees. But they realized giving hundreds of employees direct shareholding was going to be a nightmare.
Why? What were the problems?
Well, first, having lots of small, dispersed individual shareholders can really complicate things, like getting approvals needed for an IPO. They might be hard to track down, or some might even try to block things. The source mentions Terabyte's digital and UPI home furnishing as examples where this caused headaches.
Okay, logistical nightmare.
Yeah, and just the sheer paperwork of managing so many individual shareholders, plus handling exits when employees leave, it's very complex.
So Hikvision's first step was using holding companies instead. Kangpu and Wixun.
Exactly. They set up these holding companies to hold the employee shares indirectly. That solved the dispersed shareholder problem. But it created a major tax problem down the road when employees wanted to cash out.
The painful reduction problem, the source calls it.
Right. Because when the holding company sold the underlying Hikvision shares, the holding company itself had to pay corporate income tax 25% at the time.
Okay.
Then, when the holding company distributed the remaining cash profit out to the individual employee shareholders, those individuals had to pay personal income tax on the dividends, another 20% on the remaining 75%.
Ouch. So like 25% off the top, then 20% of what's left. That adds up.
It adds up to roughly a 40% total tax hit from the original gain. Very painful indeed.
So how did they fix that? What was the ultimate solution?
The ultimate solution was quite specific and relied on a particular local policy. They actually relocated those two holding companies, Kangpu and Wixun, to Urumqi in Xinjiang.
Relocated them.
Yes. And then, crucially, they converted them from standard companies into limited partnerships. Xinjiang had policies at the time that facilitated this kind of conversion and offered potential tax advantages for LPs.
Ah, okay. So the benefit of converting to an LP there was mainly tax.
That was a huge part of it. The source highlights the wonderful uses of the LP structure. First, tax saving. LPs are generally treated as tax transparent or pass-through entities.
Meaning the LP itself doesn't pay tax.
Correct. The profit flows through directly to the partners, and it's taxed only once, at the partner level. In Xinjiang at that time, the tax rate for individual partners on income from the partnership was often 20%, and there were sometimes local fiscal rebates that could reduce the effective rate even further.
So much better than the 40% effective rate they faced with the holding company structure.
Significantly better, yes. Huge tax savings. And second, the other wonderful use was that money power separation we talked about. The flexible LP agreement allowed the GP, representing management founders, to retain voting control over the Hikvision shares, while the LPs, the employees, primarily received the economic benefits.
So LP, great for tax efficiency, great for separating control and financial rights. Powerful tool. What's the second method the source highlights?
The pyramid structure.
Ah, yes. Layers upon layers of companies.
Exactly. It's a multi-layered ownership structure where one entity controls a subsidiary, which in
Right.
turn controls another subsidiary, and so on down the chain. Control cascades downwards.
How does that help with control versus equity?
Well, the simple Wang Boss Tiangu example in the source illustrates it.
Mhm.
Imagine Wang Boss owns 51% of Company A. Company A then owns 51% of Company B. Company B owns 51% of the target operating company, Tiangu.
Okay.
Wang Boss only needed to put up capital for 51% of A, which needed 51% of B, which needed 51% of Tiangu. His actual economic interest, his cash flow right in Tiangu, is much smaller, 51% by 51%, which is about 13%. But he has effective control because he controls the majority vote at each level.
Right. You use leverage through the layers to control a much larger asset base with less direct capital. Equity leverage.
Precisely. The source mentions Taisley, a listed pharmaceutical company, as a real-world example using a four-level pyramid structure to achieve significant control leverage, a ratio of 3.63, meaning their control rights were 3.63 times their cash flow rights.
Impressive leverage. So what are the main inspirations, as the source calls them, for using these holding company pyramids?
Well, equity leverage is the primary one, using small to control large, achieving greater control rights with disproportionately smaller cash flow rights. The Changjiang Renfa example is cited, where the controlling family had only an 18.54% ultimate cash flow right, but maintained 35.42% control through their pyramid.
Okay, leverage is key. What else?
Tax planning is another major benefit. Holding companies within the pyramid can act as tax-efficient pools for capital.
How so?
Because, under Chinese tax law, dividends paid between resident holding companies and their subsidiaries are generally tax-exempt. The source uses the Tung Kun stock example, which is quite striking.
What happened there?
Their holding company structure allowed over 1.1 billion RMB in dividends to flow up from the operating subsidiary to the holding company completely tax-free. That capital could then be reinvested within the group, perhaps into new ventures, without the founder having to pay the significant individual income tax they would have owed if they'd received those dividends directly.
Wow, keeping over 1 billion RMB inside the structure for reinvestment, avoiding that personal tax hit. That's huge.
It really is. Pyramids also facilitate debt financing. A strong holding company at the top can often borrow more easily or provide guarantees for the entire group's financing needs, including funding non-listed businesses under the same umbrella.
Makes sense, consolidating borrowing power.
It can also help with convenient personnel arrangement. Sometimes you might have senior executives who are no longer suited for the fast pace of the main operating company. A holding company level provides a place to move them, creating senior roles there while opening up pathways for younger talent in the operating entity below.
Interesting. A way to manage careers and succession.
Yeah. And sometimes the holding company itself can be listed, maybe on an overseas exchange like Hong Kong. Fosun International is given as an example.
Yeah.
This creates another financing platform for the group. And finally, even after the main operating company is listed, the pyramid structure can help with post-listing market value management. It can simplify things like transferring assets between the listed entity and other parts of the group, Huarun example, or even make it easier to transfer control of the entire group by just selling shares of the top holding company, Kaohsiung Holding example, rather than dealing directly with the listed shares.
So pyramids offer leverage, tax benefits, financing advantages, personnel options, and capital markets flexibility. Both LPs and pyramids seem really powerful for separating money and power. How does the source compare the two? They seem quite different in structure.
They are different, and the comparison really focuses on two main aspects: tax burden and flexibility.
Okay, tax first. How do they stack up?
Well, for ongoing dividends, the tax treatment can sometimes end up being similar, especially for long-term strategic investors holding through a company structure. But for tax on transferring shares, like when an investor exits, LPs often have an advantage, especially for purely financial investors,
Why is that?
because the tax rate on capital gains realized by individual partners exiting an LP investment can sometimes be lower than the combined corporate and individual tax hit from exiting via a holding company structure. The source mentions the Xinjiang example again, where specific local policies could make the LP exit very tax efficient.
So the optimal choice depends on the investor's goal. Exit versus long-term hold.
Exactly. The Upai home furnishing example is used to illustrate this. They had both strategic investors, who used a holding company structure, and financial investors, who used an LP structure, as shareholders, reflecting these different goals and tax considerations.
Okay, so tax depends on the situation. What about flexibility?
This is where LPs really stand out, according to the source. The limited partnership agreement offers vastly greater flexibility in designing the internal governance, the rules about control, profit sharing, etc., compared to a standard company.
More flexible than company law allows for corporations.
Much more so, especially compared to shareholding companies, which have quite rigid rules. The source uses the Mr. Bayungo example. To get absolute control over major decisions in an LLC, Mr. Bai might need 67% ownership.
Right.
But if he set up an LP structure where he was the GP, the partnership agreement could potentially grant him full control with as little as, say, 1% of the capital contribution, if the LPs agree to that arrangement.
Wow, that's a huge difference in the capital needed for control.
It highlights the power of the customizable LP agreement. Now, the source does caution that LPs are a relatively newer structure in China compared to traditional companies, and the legal framework is still evolving. So you need to take a holistic view, considering tax, legal stability, and your ultimate business goals when choosing between an LP and a pyramid.
Makes sense. Weigh the pros and cons carefully.
Okay.
Okay, let's move to the third method, concerted action. What's this about?
Concerted action, or acting in concert, is basically an agreement between two or more shareholders to vote their shares together in a coordinated way.
So they form a voting bloc.
Essentially, yes. It can be a formal written agreement, or sometimes even an informal understanding, though formal is better for clarity. They agree to vote the same way on specific matters, or maybe on all matters, effectively pooling their voting power. The source even mentions there can be penalties if someone breaks the agreement.
Okay. And this applies differently for listed versus non-listed companies.
Yes, particularly for listed companies. Securities regulators often automatically presume certain related parties are acting in concert, even without a formal agreement.
Like who?
The rules list various relationships, spouses, parents, children, companies controlled by the same person, etc. If those relationships exist between shareholders, regulators might just treat their votes as a single block, unless proven otherwise.
Okay. The source uses the Yanglian drink example for this one.
Right. The founder, Yao Kusang, initially held about 30% of the shares. That wasn't quite enough to guarantee control over certain major decisions needed for their IPO.
So what did he do?
He entered into a formal concerted action agreement with another shareholder entity called Yazishun. Interestingly, he didn't individually control Yazishun, but they agreed to vote together. This combined their voting power to over 43%, giving them solid control for the IPO process.
A practical way to boost your voting percentage by aligning with friendly parties.
Exactly. However, the source also points out that concerted action agreements have limitations.
Like what? What are the downsides?
Well, first, they often have a limited term. The agreement might only last for, say, 3 years, or until a specific event like the IPO is completed. The Starry Technology example is mentioned where the agreement expired.
So they're not necessarily permanent.
No. And second, related to that, they can be terminated. Sometimes the parties just agree to end the arrangement once the initial purpose, like getting through the IPO, has been achieved. The Wodzixon example showed this.
Okay. Temporary and terminable. Anything else?
A key weakness is that these agreements are typically not binding on third parties. Meaning, if one of the shareholders who signed the agreement sells their shares, the new buyer isn't automatically bound by that agreement. Same if a shareholder passes away, their heirs aren't automatically part of the voting bloc. This can weaken the bloc over time, especially in public companies where shares change hands frequently.
Right. The agreement is just between the original signers. So how can you make it stronger?
A practical tip offered in the source is to try and incorporate the key terms of the concerted action arrangement directly into the company's articles of association.
Put it in the company's constitution again. Why is that better?
Because the articles are binding on all shareholders, present and future. Anyone who buys shares later is subject to the rules laid out in the articles. The Furu Pharmaceuticals example is used, where they actually wrote clauses about the founder and certain other shareholders acting in concert directly into their articles, making that arrangement much more durable and effective against potential future dissenting shareholders.
Clever. Making a private deal part of the public company rules. Okay, method number 4 is voting proxy. How does this one work?
Voting proxy, or sometimes called delegated voting rights, is simpler in concept. It's where one shareholder formally transfers their right to vote their shares to another party.
Just hands over the vote.
Essentially, yes. They give someone else the authority to vote their shares for them. This other party could be another shareholder, or importantly, it could even be someone who doesn't own any shares in the company at all, like a trusted advisor or even company management.
Okay. The Tianchang stock example is used here.
Right. Tianchang Stock was a listed company that had a subsidiary. In that subsidiary, there was a minority shareholder named Xiao Kaixia, holding 19%. She was described as a passive financial investor, living elsewhere, not involved in operations.
So she didn't really care about voting.
Apparently not. She agreed to sign a voting proxy agreement, transferring her voting rights for that 19% stake over to the parent company, Tianchang Stock. She kept her economic rights, the right to dividends and to sell the shares, but gave up the vote.
Why did the parent company want her vote?
It simplified their control over the subsidiary, which was important because they needed to consolidate the subsidiary's financial results onto their own books for their own IPO. Having clear voting control helped with that accounting consolidation. Later, the source notes, she actually gave up voting rights for another chunk of shares for similar reasons.
So useful when you have passive investors who don't want the hassle of voting. How is this different from concerted action then? They sound a bit similar.
The source makes a key distinction. Concerted action is an agreement between shareholders on how they will vote their shares together. They each still hold their own vote, they just coordinate.
Okay.
Voting proxy is a transfer of the actual ability or right to vote from one person to another. The recipient casts the vote instead of the original shareholder. Also, as mentioned, the proxy recipient doesn't need to be a shareholder themselves.
Got it. Proxy transfer the vote itself. Concerted action, agree how to use your own vote. Makes sense. Okay, method number 5. Control via articles of association.
Yes, back to the power of the company's constitution.
We saw it used to strengthen concerted action, and now as a control method in its own right.
Absolutely. The source really emphasizes that the articles are the supreme internal law of the company. It mentions that perhaps historically in China, articles sometimes didn't get the detailed attention they deserved, maybe because ownership was often concentrated or cultural factors played a role.
But that's changing.
Yes, driven partly by high-profile corporate control battles. There's a growing awareness now that carefully drafted articles can be a really powerful tool both for setting up control structures and for defending against challenges.
So a well-drafted article can act like a shield.
A very potent one,
Right.
potentially. The Shanghai Sinmei example is fascinating here. They faced a potential hostile takeover situation.
What did they do?
They amended their Articles of Association, specifically Article 53, to introduce a new rule. Any shareholder wanting to propose temporary motions at a shareholder meeting had to have continuously held their shares for at least 12 months.
A full year, just to propose something.
Correct. You couldn't just buy shares and immediately start trying to change things or disrupt management by flooding the agenda with proposals.
That seems like a pretty strong defense against short-term activists or quick takeover attempts.
Exactly. The stated justification, which the source notes was confirmed as legally viable by lawyers at the time, was precisely that: to prevent disruption from shareholders with short-term or potentially malicious intentions, and ensure proposals came from those with a longer-term commitment to the company.
A really creative use of the articles as a defensive moat.
It shows the strategic possibilities within that foundational document.
Okay. And the last method mentioned briefly is AB shares.
Right. The AB share structure, or dual class shares. This is a system where a company issues different classes of common stock, carrying different voting rights.
For example.
For example, Class A shares, often held by founders or insiders, might carry 10 votes per share, while Class B shares, typically sold to the public, might carry only 1 vote per share.
So this allows the founders to maintain majority voting control even if they own a significantly smaller percentage of the total equity.
Precisely. It directly separates voting power from economic ownership. The source just notes Xiaomi Group as an example of a company using this structure, which is quite common now, especially among tech companies listing in places like the US or Hong Kong.
Okay. So putting it all together, we've got this toolkit for separating money from power, limited partnerships offering flexibility and tax efficiency, pyramid structures for leverage and tax planning, concerted action agreements to unify friendly votes, voting proxies to consolidate votes from passive holders, using the Articles of Association strategically for rules and defense, and AB shares for formally unequal voting rights.
That's a great summary. These are really the essential strategies the source outlines for founders and controlling shareholders who need to navigate that tricky balance. bringing in capital or talent through equity, while still retaining strategic control over the company's future direction.
This has been a really insightful deep dive, I think, into this fascinating, often quite hidden world of stock ownership and control, drawing directly from the insights in that book, One Book to Understand Stock Ownership Structures.
Yeah, we've seen how those specific percentages, 34, 51, 67, 30, 10, 5, 1%, how they act as triggers, unlocking different rights, different obligations depending on the type of company. And we've explored these powerful methods owners use to essentially keep control even when they don't own the majority of the equity.
I think the big takeaway here for anyone listening is that understanding these numbers, these structures, it isn't just for the lawyers or the finance gurus. It's really fundamental knowledge if you're building a business, if you're investing in one, or honestly, even if you're just trying to make sense of how power actually operates in the corporate world we live in.
Absolutely. And the right approach, the best structure, isn't universal. It completely depends on what your goals are. Are you a financial investor just looking for the best exit value, or are you a strategic owner focused on long-term control and building the enterprise? Your objective really dictates which tools, which percentages matter most to you.
Yeah. It brings us back to that thought from the introduction, doesn't it? That idea, maybe echoing Yuval Noah Harari's point about wheat domesticating humans.
Ah, surprising parallel, yeah.
We spend so much time and energy focusing on how we control equity, right? We use it to build companies, gather resources, consolidate wealth, direct power. But maybe, just maybe, like wheat, equity also fundamentally shapes us. It dictates the very structures we build, the complex rules we have to follow, the relationships we form within those structures, the strategies we're forced to employ. So the question is, are we truly mastering equity, or is it, in some subtle but profound way, actually mastering us?
That's definitely a thought to ponder as you look at the landscape of corporate ownership and power dynamics out there.
Indeed. Something to think about.